In order to answer the question, what is accounting, I'd like to start with what it is not. Accounting is not a math class, or at least it's not this kind of a math class. It's more like this kind of a math class because it's basically just addition and subtraction. Although at some point, all students will feel like it's this kind of a math class. And that's because accounting is really a foreign language class. Accounting is commonly referred to as the language of business. For most beginning students, business is like a foreign environment. So by learning accounting, we can better understand business and the environment in which it operates. I like to think of it with this example. Imagine you are traveling in a foreign country where you don't speak the language. Would it be easy for you to get around, order meals, arrange hotel and travel accommodations? I think you could see that that could be quite challenging. However, if you had some proficiency in the foreign language, your trip would likely be more enjoyable. Well, so it is in understanding accounting, regardless of what your job is in business. So how do students study for language classes? With practice and immersion. So how should students study for accounting classes? With practice and immersion. So with practice, this will become this. And when we combine simple math and new terms foreign to beginning students, we will start to understand financial transactions. And so accounting tracks the financial transactions of a business, records the financial transactions in an information system, and reports those results to interested groups. And this concludes our brief introduction to accounting in general, but in fact there are many different kinds of accounting, so I would encourage you to keep going in the video series. Step 2 in the accounting cycle is journalizing transactions. This is the process whereby financial transactions are recorded into the accounting records of a company. Transactions are recorded with a journal entry. These journal entries become the chronological list of all the transactions, and that list is known as the general journal. Journal entries have 4 parts: a date of the transaction, the account debited and the dollar amount debited, the account credited and the dollar amount of the credit, and finally a brief explanation of the transaction. This slide is a visual example of a journal entry. You can see the date section, where the accounts are listed, the debit and credit column, and finally where the explanation is shown. So let's look at the 3 transactions we previously analyzed and see if we can journalize them. In this example, a company buys supplies on account for $500 on August 3rd. When we analyze this transaction, we determine that supplies, an asset account, is increased with a debit, and accounts payable, a liability account, is increased with a credit. So first we enter the date, August 3rd. Then we list the debit account first, so we enter supplies. It wouldn't technically be wrong to list the credit account first, but it would look wrong to every practicing accountant. So always enter the debit accounts first. Then we would record $500 in the debit column. Next, we enter accounts payable as the credit account. Normally we indent credits, as you can see here. And finally, we enter $500 into the credit column. We enter the description of the transaction at the bottom. Often in accounting homework, you won't need to enter a description, but you should be aware that in real life, journal entries always have at least this type of documentation. And now we're done. We've entered this transaction into the general journal by completing a journal entry. Let's look at another example. A company performs service on account for $2,500 on August 9th. We analyzed this transaction and determined that accounts receivable, an asset account, is increased with a debit. Service revenue, a revenue account, is increased with a credit. So we'll enter the date, August 9th. We will then list the debit account, so we enter accounts receivable, and in the debit column we'll enter $2,500. Next, we'll enter service revenue as the credit account. We'll want to indent the credit, and then enter $2,500 in the credit column. Finally, we would enter the transaction, and we're done. We've entered this transaction into the general journal. The last example, a company pays a utility bill for $200 on August 15th. When we analyze this transaction, we determine the cash and asset account is decreased with a credit, and utilities expense, an expense account, is increased with a debit. So we'll enter the date, August 15th. We will then list the debit account first, so we will enter utilities expense, and then $200 in the debit column. Next, we enter cash in the credit account. We'll want to indent cash, as you can see here, and then $200 in the credit column. Finally, we would enter a description for this transaction. And we've now entered this transaction into the general journal. I hope these brief examples have helped you understand the journalizing transaction step in the accounting cycle. One hint I would like you to remember: once you've analyzed the transaction, you don't need to reanalyze them when you journalize them. Just enter the date, the debit account and amount, the credit account and amount, and the description if the problem asks for it. No additional analysis needed. The third step in the accounting cycle is posting transactions from the journal to the ledger. This is a process of copying data from the journal to the ledger, which in accounting we show as the T account. Recall that debits are always on the left and credits are always on the right. The process of posting is fairly straightforward. In fact, I would suggest that you don't overthink the process. It starts with identifying the debit account and the amount from the journal. Then find that account in the ledger. Record the amount as a debit or on the left side of the account. Then do the same thing for the credit account. Identify the credit account and amount, find that account in the ledger, and finally record the amount as a credit or on the right side of the account. Let's look at this example. We have a journal entry where we've debited accounts receivable for $2,000 and credited sales revenue for $2,000. The date is January 5th. In the ledger, we will need to find the accounts receivable account and the sales revenue account. Then identify the debit account, which is accounts receivable. The amount of the debit, $2,000. So in the ledger for accounts receivable, we will post or record $2,000 to the debit side, like this. Make sure to include the date or some reference to the journal transaction. Now let's post the credit. Identify the credit account, which in this case is service revenue, the amount of the credit, $2,000. So in the ledger for service revenue, we will record or post $2,000 to the credit side, like this. And don't forget the date. So now you can see that the amounts from the journal have been posted in the ledger. The importance of this step is to make sure that all similar transactions are recorded in the same place. If you were an accountant for this company and you wanted to know how much service revenue your company had for a month, without this step, you would have to go through every single journal entry in the general journal looking for those that affected revenue. That would be quite time-consuming, even for the smallest of businesses. Okay, let's look at the three previous examples and put this step in context of the accounting cycle. In this example, a company bought supplies for $500 on account. The date was August 3rd. So we analyzed the transaction and we journalized it like this. Now we need to post this to the ledger. Supplies is the debit account and the amount is $500. So we post $500 and the date to the debit side of the supplies account. Accounts payable is the credit account and the amount is also $500. So we post $500 and the date to the credit side of the accounts payable account. In this next example, a company performs service on account for $2,500. The date is August 9th. Accounts receivable is the debit account and the amount is $2,500. So we post $2,500 and the date to the debit side of accounts receivable. The service revenue is the credit account and the amount is $2,500. So we post $2,500 and the date to the credit side of service revenue. In this final example, a company pays a utility bill for $200. The date is August 15th. Utilities expense is the debit account and the amount is $200. So we post $200 and the date to the debit side of the utilities expense account. Cash is the credit account and the amount is $200. So we post $200 and the date to the credit side of the cash account. Finally, let me add that these first three steps of the accounting cycle are repeated over and over again during the month. The remainder of the accounting cycle all happens at the end of the month. But more on that in future videos. Preparing the unadjusted trial balance is the fourth step in the accounting cycle. A trial balance is a list of company accounts and their ending ledger balances. Its primary purpose at this step is to make sure that debits equal credits. The trial balance is prepared at the end of the accounting period, as are all of the subsequent steps in the accounting cycle. The trial balance lists accounts in the following order: assets, liabilities, equity, revenues, and expenses. Before we look at how to prepare the trial balance, let's revisit how we arrive at the ending balances in our ledger accounts. Account balances are either debit balances or credit balances. There are no negative balances in accounting. Balances are calculated by totaling the debit side of an account and totaling the credit side of an account. Then subtract the smaller side from the larger. This is the balance on the larger side. An account can have only one balance. In this example, debits are $20,000 and credits are $9,000. So the balance in this account is an $11,000 debit. In this example, debits are $15,000 and credits are $17,000. So the balance in this account is a $2,000 credit. Now here's an example of a trial balance. Notice the account order is assets, liabilities, equity, revenues, and finally expenses. Let's look at the details as to how we arrived at these balances. So in this example, all of the debits totaled $18,300 and all of the credits totaled $10,250. Therefore, the cash account has a debit balance of $8,050. So on the trial balance, we would enter cash as the first account and $8,050 in the debit column. Then we would repeat this process for all of the other accounts that have balances. Normally, accounts that have no balances would not appear on the trial balance. Some additional terminology that you should be aware of is the chart of accounts. The chart of accounts are all of the accounts available for use in a company. It is likely that accounts on the chart of accounts may not be used all of the time. The chart of accounts is not the same thing as the trial balance, which are the accounts that are used and have balances. Here is a short example of a chart of accounts. In academia, we identify accounts by their names, like cash or service revenue. But in real life and in accounting information systems, accounts are identified by an assigned account number, like 100 or 400. So much of what we've covered in this video deals with the trial balance in general. I'd like to identify why this is an unadjusted trial balance. Specifically, other than telling us the balances of our ledger accounts at this time and whether or not our debits equal our credits, the adjusted trial balance doesn't tell us very much. For example, look at the supplies balance. That balance has likely come from the purchase of supplies during the month. However, it may not be the amount of supplies on hand at the end of the month if we've used some of them. So there are limitations to the adjusted trial balance, including some transactions may not have been journalized. The correct journal entry might not have been posted. A journal entry may have been entered or posted twice. Incorrect accounts may have been used in the journalizing or posting of transactions. Or offsetting errors are made in the recording of the transactions. In fact, this is why we need to perform the next step in the accounting cycle, adjusting journal entries. So we can adjust the account balances to more accurately reflect the financial position of a company. And that concludes this short video on preparing the unadjusted trial balance. Let's revisit the accounting cycle. Notice that step 5 relates to adjusting journal entries. So question, why adjust account balances? Why do they need adjustment? Adjusting entries are necessary because the unadjusted trial balance may not contain up-to-date and complete data as you've learned when you studied the unadjusted trial balance. Adjusting entries update asset and liability accounts as well as revenue and expense accounts. Without this adjustment, our financial statements could mislead investors and creditors. Finally, adjusting entries help ensure that the revenue recognition and matching principle are followed. So let's look at an example. A company buys $500 of supplies during the month. At the end of the month, the unadjusted trial balance shows $500 for supplies. Is $500 the correct amount? Isn't it likely that the company has used some of the supplies? Yet, no one wants to make a journal entry each time someone takes a pen or staples some papers. That would be a horribly inefficient use of time. Yet pens were used and papers were stapled, and those things need to be accounted for. So this is why accountants record adjusting journal entries at the end of the period. Failure to record the adjusting journal entry to adjust the supplies account would result in an overstatement of assets, meaning too much money in assets, and an understatement of expense, too little supplies expense at the end of the accounting period. Overstatement and understatement are two concepts students struggle with. They definitely require critical thinking about the transactions to figure it out. So when we make adjusting entries, there are two main types of subcategories. One is deferrals and the other is accruals. One type of deferral is prepaid expenses. This means that cash is paid before expense is incurred. Some common examples of adjusting entries for prepaid expenses are prepaid rent, supplies, and depreciation. Another type of deferral is unearned revenue. This means that cash is received before revenue is earned. Some common examples of adjusting entries for unearned revenues are unearned rent revenue, season ticket revenue, airline ticket revenue, like that. An example of an accrual is accrued revenues. This means that cash is received after revenue is earned. Some common examples of adjusting entries for accrued revenues are service revenue and interest revenue. Another type of accrual is accrued expenses. This means that cash is paid after the expense is incurred. Companies tend to have a lot of accrued expenses, as this is the most common type of adjusting entry. Some common examples of adjusting entries for accrued expenses are salary expense and interest expense. Finally, let's look at some characteristics of an adjusting entry and how they differ from a regular journal entry made in the ordinary course of business. The first is that there is no underlying business event that causes an adjusting entry to happen. They happen most often because of the passage of time or that information isn't available in the period we need it. They are recorded at the end of the accounting period, so adjusting journal entries will be dated at the end of the month. They will always include one income statement account and one balance sheet account. Again, this requires some critical thinking, but you can usually figure out the accounts affected by an adjusting entry by remembering this. And finally, they will never, ever, never, ever, ever, ever include the cash account. At some point, you are going to be really tempted to use the cash account when doing an adjusting entry. Please don't. It is certainly wrong. Now, I will say that there is an exception to this, and that is when we are doing adjusting entries from the bank reconciliation. But that's not what's happening in this context, so don't use cash. They are required every time a company prepares financial statements. Look at the steps here. You can't do step 7, prepare financial statements, without first doing step 5, journalize, and post adjusting entries. Preparing the adjusted trial balance is the 6th step in the accounting cycle. We learned earlier that a trial balance is a list of company accounts and their ending ledger balances. The adjusted trial balance is prepared after our accounts have been adjusted. It represents the best information a company has to prepare financial statements. It is the basis for financial statement preparation. Let's remember the trial balance lists accounts in the following order: assets, liabilities, equity, revenues, and expenses. Here we have an unadjusted trial balance. We make the adjusting journal entries and post them to the ledger. Then the ending ledger balance after adjustment is used to prepare the adjusted trial balance. In this case, service revenue had a 0 beginning balance, and after adjustment, now has a credit balance of $162,500. So then the adjusted trial balance looks like this. Recall that the adjusted trial balance represents the best information we can provide our investors and creditors. We will use the adjusted trial balance to prepare the financial statements. For example, revenues and expenses will go on the income statement and produce net income. Owner's capital, owner's withdrawals, if this company had any, and net income from the income statement will go on the statement of owner's equity and produce ending owner's capital. Assets, liabilities, and owner's capital from the statement of owner's equity will go on the balance sheet. We will learn more about financial statements in Accounting Cycle Step 7, Preparing Financial Statements. The financial statements are prepared directly from the adjusted trial balance. The focus of this video is the classified balance sheet. The balance sheet includes a company's assets, liabilities, and equity accounts, specifically the ending owner's capital, which comes from the statement of owner's equity. In order to understand how to prepare a classified balance sheet, we need to learn a few new terms. A classified balance sheet lists assets and liabilities in order of their liquidity. Liquidity measures quickness of cash, meaning how quickly assets will be turned to cash or how soon liabilities need to be paid. Then assets and liabilities are listed in their order of liquidity. Assets that will be turned to cash, sold, or used within 1 year or 1 operating cycle, whichever is more, are classified as current assets. Liabilities that will be paid within 1 year or 1 operating cycle, whichever is more, are classified as current liabilities. We will define the operating cycle in a future video, but just so you know, almost all companies have many operating cycles within 1 year, so the year is basically the cutoff. Assets which have useful lives longer than 1 year or will require more than 1 year to be turned to cash or sold are classified as long-term assets, or sometimes called non-current assets. Liabilities which take longer than 1 year to pay off are classified as long-term liabilities, or sometimes long-term debt. So let's use the adjusted trial balance and prepare the classified balance sheet. We take the assets and liabilities from the trial balance and we put those on the balance sheet. Additionally, we will use the ending owner's capital balance from the statement of owner's equity. The balance sheet has a company name, the name of the financial statement, and the date, which is either just the date or sometimes as of and then the date. The balance sheet reports assets, liabilities, and equity for a point in time rather than a period of time. This is because the investors and creditors want to know the financial position today, not some accumulated amount that has no meaning. For example, which of these two are more relevant to financial decision making? How much money you have right now, or how much money you've had over your entire life? Certainly what you have now is the only thing that would impact a future financial decision like buying a home. On the asset side, we start with the current assets section. Here we will list our current assets in order of liquidity and then total them. Next, we will prepare our long-term assets section. These items are often grouped like this: investments, plant assets, intangible assets, and other non-current assets. In this introductory video, we'll just list them since all we have are plant assets. Finally, we total our assets. Then we move on to the liability side and start with current liabilities. Here we will list our current liabilities in order of liquidity and then total them. Then our long-term liabilities are listed and we will total our liabilities. Finally, we prepare the owner's equity section. Here is where we report the ending owner's capital from the statement of owner's equity. Then that becomes total owner's equity. Finally, we total liabilities and owner's equity. If we've done everything correctly, it should be the same amount as total assets. One final note. All of the accounts and amounts reported to our investors and creditors are the same as the adjusted trial balance, except one. Owner's capital has a different account balance than what we reported. This will get corrected in the next step in the accounting cycle, which is closing journal entries. Recall that the purpose of financial accounting is to provide useful information to investors and creditors about a company. The root of that information is the financial statements. The financial statements are prepared directly from the adjusted trial balance. The focus of this short video is on the income statement. Financial statements are prepared in a specific order, with the income statement being first. This is because some information from one statement is needed to complete others. Recall that an income statement includes a company's revenues and expense accounts, and the net of those two is net income. So let's use the adjusted trial balance to complete the financial statements. We take revenues and expenses from the trial balance and put those on the income statement. The income statement has the company name, the name of the financial statement, which is the income statement, and the date, which is always year-ended, and then whatever the date is. Income statements can be prepared for month-ended or quarter-ended as well. The statement needs to reflect the time period. So income statements detail revenues and expenses of a business for a period or range of time. That's why the date is so important. Our investors and creditors need to know the period of time the statement covers. Revenues are listed first. if we have more than one type of revenue, we would likely subtotal them and list the total revenue in the far column. Expenses are listed next. Since companies have many types of expenses, we would subtotal them and list the total expenses in the far column. The difference between the two is net income. Please note that the columns on the financial statements are just for totals and subtotals. They do not mean debit and credit. There are two primary formats for the income statement: the single-step income statement, which you're already familiar with, and the multi-step income statement, which we will learn about in this podcast. The single-step income statement lists all revenues together and totals them for total revenue. Then all expenses are listed together and totaled for total expenses. The difference is then net income. This format is primarily used by service firms. Here's an example of a single-step income statement. You can see that revenues and gains, which we'll learn about later, are all listed together. Same with expenses. Let me point out one area of the presentation that some students struggle with. Often when we report financial statements, if we have a list of common accounts like revenues and expenses, we will list them all in one column and carry the total out to the far column. That does not mean, the columns don't mean debit and credit in this case, not when we're presenting the financial statements. A multi-step income statement still lists revenues and expenses, but it separates operating revenues and expenses from non-operating revenues and expenses, as well as divides the account into important subtotals that highlight areas of importance for investors and creditors. The subtotals include gross profit and operating income. Here is an example of the multi-step income statement. You can see the different subtotals listed. Again, you will see items on an inner column being subtotaled and then that amount being carried to the outer column. Again, that does not mean debit or credit, so please remember that. Now let's look at the multi-step income statement more closely. The multi-step income statement starts with the calculation of net sales revenue. No other revenue is included in this section. So sales revenue is reported first, then sales returns and allowances and sales discounts are deducted to arrive at net sales revenue. The next important subtotal is gross profit. This is calculated by taking net sales revenue minus costs of goods sold. At this point, costs of goods sold is the only expense deducted in this section. You recall that gross profit is the amount that inventory was sold for more than the cost of inventory. The next section lists all of the operating expenses of a business. Notice that not all expenses are listed here because not all expenses relate to operations. The most notable expense that doesn't belong in this section is interest expense, because interest expense relates to how a business finances its operation, not operates it. So here, operating expenses are deducted from gross profit to arrive at operating income. Operating income has a few different names that you might hear from time to time. It is also known as income from operations, or EBIT. EBIT stands for earnings before interest and taxes. In fact, when we look back at the multi-step income statement, you'll see that about the only things that remain are interest and taxes. Operating income is one of the most important pieces of financial data for investors and creditors because it tends to be more repeatable than net income, which may include some one-time events. Therefore, it has a higher predictive value, and that is important to investors. The next section of the income statement reports non-operating revenues and expenses. These items are either one-time amounts, like gain on sale of land or loss from earthquake damage, or items not part of central operations, like interest revenue, which is earned by making a loan, or interest expense, which is incurred by financing assets with debt. This section is sometimes known as the other section. So here, other revenues and gains are added to operating income, and other expenses and losses are deducted from operating income. This gives us a new subtotal called income before taxes. The final section before we arrive at net income, or at least the final section for an accounting principles course, is the income tax expense section. This expense is reported separately from all other expenses because it's the expense that managers have the least control over. So income tax expense is deducted from income before taxes to arrive at net income. So which format is better? Well, it depends. The single step is easier to read and understand. For service firms which don't have gross profit, and there isn't a lot of benefit from distinguishing between operating and non-operating activities, it's the simple way to express profitability. But there are some drawbacks. In the example, this firm earned $80,000 of net income on $303,000 of revenue. But the question is, how repeatable is that next year? Let's answer that by looking at the multi-step format. The multi-step format gives us better information about gross profit and operating income. That is why non-service firms use this format. Notice that although the company had $80,000 of net income from $200,000 of net sales revenue, operating income was only $45,000. In fact, $80,000 net came from the non-operating section. If you recall, this company had a $100,000 gain on the sale of land. How repeatable is that? Could they just sell land at a profit each year into perpetuity? No, they can't. And that's why the multi-step format breaks out the different types of account data so investors and creditors can make more informed and better decisions. And that concludes this short video on the multi-step income statement. The accounts we've been learning about can be categorized a number of different ways. We've categorized accounts by which financial statement they're reported on. We've categorized accounts by whether they are current or long-term. And now we're going to learn to categorize accounts a new way, temporary or permanent. Temporary accounts are closed at the end of the period. Closed means to zero the account balance. Permanent accounts are unaffected by closing journal entries, with the exception of owner's capital. The income summary account, which is a new account for us, is a transitional account into which all revenues and expense accounts are transferred at the end of the period. The net amount transferred equals our net income or net loss. This account is rarely used by companies, but some textbooks still show this method, so we want to cover it. So the closing journal entries is a formal process of moving revenues, expenses, and owner's withdrawals to owner's capital. You recall very early on that we learned that revenues increase equity, while expenses and owner's withdrawals decrease equity. Up until this point, that has all been conceptual. When we record the closing journal entries, this is when those impacts on equity actually happen. And finally, we close accounts to prepare our accounts to begin the next accounting period with zero balances. Here's some data from Coca-Cola's 2013 financial statements. The operating revenue is a temporary account. The amounts shown are the amounts earned in that year, not the total amount of revenue Coke has ever earned. Since each year revenues are closed, so each year revenues are closed so that Coke can begin tracking revenues for the next year. Cash, on the other hand, is not closed. This is the amount of cash Coke had on hand at the end of last year. It wouldn't make sense to close this account and start the new year with a zero balance in our cash account. Coke would start the new year with a beginning balance that was last year's ending balance. So let's look at the adjusted trial balance and learn how to make closing journal entries. Here is an example of an adjusted trial balance. We could have also used the financial statements to make the closing journal entries. Let's start with service revenue, which has a credit balance of $4,000. The first journal entry is to close revenues to income summary. Since revenues have a $4,000 credit balance, we will debit service revenue to make the balance zero. Income summary will then be credited. After posting this entry, the balance in service revenue account is zero. Note that if we would have had more than one revenue account, like rent revenue and interest revenue, we would have included them in the journal entry like this. Next, we will close our expense accounts. The second journal entry is to close expenses to income summary. We record our expenses separately in the journal entry because each account needs to be zeroed out. You can see that in the example. Income summary will then be debited for the total of the expenses. After posting this journal entry, our expenses will all be zeroed out. The third journal entry, the third closing journal entry is to close income summary to owner's capital. To do this, we need to figure out the ending balance in income summary. Once we've posted the first two journal entries, we can determine the balance in income summary. The balance should equal our net income. In this case, the balance is $700 credit. So to close income summary, we will debit the account $700. The balance is now zero, and it will remain zero until next period when we close our temporary accounts all over again. The credit is to owner's capital. The last temporary account to close is owner's withdrawals. So the final journal entry is to close owner's withdrawals to owner's capital. Since owner's withdrawal has a $1,000 debit balance, we will credit owner's withdrawals to make the balance zero. Owner's capital will then be debited. Note that owner's withdrawals is not an income statement account, so it is not closed to income summary first. Now let's look at the owner's capital account. We started with a balance of $9,600, a credit balance of $9,600, which came from the trial balance. We increased the account when we closed income summary. Recall that net income increases equity. This is the journal entry that made that happen. We decrease accounts when we closed owner's withdrawals. Recall that owner's withdrawals decrease equity. This is the journal entry that now made that happen. Finally, we have an ending balance of a $9,300 credit balance. Let's compare that to the statement of owner's equity. You can see now that our ledger balance for owner's capital matches what we reported on the statement of owner's equity. It's like magic, only real. And that concludes this important video on closing journal entries. Preparing the post-closing trial balance is the 9th step in the accounting cycle. This is also an optional step. It is prepared after the closing journal entries, and its purpose is to verify that the temporary accounts have been closed. Let's remember that the trial balance lists accounts in the following order: assets, liabilities, equities, revenues, and expenses. Since the temporary accounts have been closed, the post-closing trial balance only lists the balance sheet accounts. Here is an example of a post-closing trial balance. Notice it includes our asset accounts, liability accounts, and balance sheet equity account, owner's capital. Now you can see those accounts match up with what is reported on our balance sheet. And that concludes this video on the post-closing trial balance, as well as our in-depth study of the accounting cycle.